In today's video, I'm going to answer the question, what is an LIRP? Hey folks, I'm best-selling author David McKnight. Today we're going to be talking about the LIRP, or the Life Insurance Retirement Plan. For starters, what is an LIRP? Well, it's a bucket of money that gets treated differently for tax purposes than any of your more traditional investments. What happens is that you put money in, and as your money grows, your bucket begins to fill. Only the IRS says that the growth on the money in that bucket is going to be treated under a different section of the IRS tax code than any of the traditional government-sponsored retirement plans. What does that section of the IRS tax code say? It says that you can touch this money pre-59.5 without penalty. Can you do that in your 401k or your IRA? No, you can't. It's also going to say that as your money grows, you get no 1099s. What does that mean? That means no tax as your money grows. They're going to tell you that when you take the money out, if you take it out the right way, that it doesn't show up as reportable income on your tax return. What does that mean? That means that it's tax-free and does not count as provisional income. It does not count against the thresholds that cause Social Security taxation. Hey, it's time for the Power Zero question of the day. How did you first learn about the LIRP? Go ahead and put your answer in the comments section below. They're also going to tell you that there are no contribution limits. Here's an example. What are the contribution limits for the Roth IRA? For married couples over age 50, it's $7,000 each for a total of $14,000 per year. Folks, I got clients that put $50 a month into this bucket, and I have clients that put $200,000 per year, and everywhere in between. There are no limits on how much you can contribute to this bucket. They're also going to tell you that there are no income limitations. Let me ask you a question. Can Bill Gates do a Roth IRA? No, he can't. How come? He makes too much money. You start making more than $214,000 of modified adjusted gross income per year, you can no longer do a Roth IRA. Can my children, the youngest of whom is 7, do a Roth IRA? No, in order to do a Roth IRA, you have to have earned income. My kids work, I just don't pay them. None of these rules apply to this particular bucket. This last one's probably my favorite. It's this: if history serves as a model, there may be no legislative risk. What does that mean? Well, let me give you an example. They changed the rules on this bucket 3 different times in 82, 84, and 88, and every single time they changed the rules, they simply said, hey, whoever has the bucket, before the rule changes, gets to keep it and continue to put money into it under the old rule for the rest of their lives. What do we call that kind of a clause? We call it a grandfather clause. Now, usually at this point, someone will say, hey, Dave, that sounds like the perfect bucket. This is like the alignment of the stars. Why not just put all my money into there? Well, first of all, is it ever a good idea to put all your eggs into any one basket? The answer is no. Not only that, but the IRS says if we're going to give you the benefit of an unlimited bucket of tax-free dollars, we're going to require that there be a cost of admission. We're going to require that there be a spigot attached to the side of that bucket through which flows on a monthly basis some expenses. And what do those expenses go towards? They go towards some administrative fees, but they primarily go towards the cost of term life insurance. Now, let me ask you a question. If your house is paid off, your kids have moved out, you're rapidly approaching retirement, is term life insurance really all that high on your wish list? The answer is no. It's usually right about now that people start dumping their term life insurance, and the companies that sponsor these programs recognize that, so they've done something to sweeten the pot. They simply say that in the event that somewhere down the road you should need long-term care, they will give you your death benefit while you're alive for the purpose of paying for it. Here's an example. Let's say you have a death benefit of $400,000. You wake up one day, you can no longer feed yourself, bathe yourself, transfer yourself, what have you. Any 2 of 6 activities of daily living. You can find one doctor to write one letter to that effect. They will start sending you 25% of that death benefit, or $100,000 per year, every year for 4 years for the purpose of paying for it. Now, they may discount that amount based on your age and what you received the benefit, but the point is this: they're willing to give you your death benefit in advance of your death while you're alive, in essence, for the purpose of paying for long-term care. Now, let me ask you a question. Have you ever looked into traditional long-term care insurance? First of all, is it cheap? The answer is no, of course not. It's getting more and more expensive all the time. Can it be hard to qualify? Sure, you might live to be 120, but if you have a bad back, a bad hip, a bad knee, you may not even get accepted. And what happens if you pay for 30 years and die peaceful in your sleep, never having used it? Do they send you all your money back at the end? The answer is no, it goes to pay for someone else's benefit. And that can be a source of heartburn for a lot of different people because nobody wants to pay for something they hope they never have to use. How is this different? This is different because if you die peacefully in your sleep, 30 years from now, never having needed long-term care, guess what? Someone's still getting a death benefit, probably your kids or your grandkids. So there isn't that sensation of having paid for something you hope you never have to use. By the way, have some people already bought off on the idea that they need term insurance and long-term care insurance? Sure. All we're suggesting is that instead of sending that money off to an insurance company in the form of a premium payment, why not recapture it, dump it into their bucket, let just a portion of it drip out in the form of expenses, and now take advantage of a huge bucket of tax-free dollars that was not previously available to you. By the way, what do we call this bucket? Chapter 5 of my best-selling book, The Power of Zero, we call it an LIRP. What does that stand for? It stands for Life Insurance Retirement Plan. Why life insurance? Because the IRS says that in order for this bucket to work, you gotta be willing to pay for some life insurance. You gotta have a need for life insurance. Why retirement plan? Because one of the ancillary goals of this bucket is to build money up so that somewhere down the road you can take money out and spend it on your lifestyle at a period in time when tax rates are likely to be much higher than they are today. If you'd like some help figuring out if the LIRP is right for you, head on over to davidmcknight.com and opt in for a complimentary strategy session. I'm happy to give you a hand. Don't forget to click like, subscribe, and the bell so you never miss a video. And feel free to make any comments or ask questions in the comments section below. This is David McKnight. I look forward to seeing you on the next video.